You check your bank account, $5,000. It's sitting there, right? Wrong. That money doesn't exist, not in the way you think it does. And if everyone who banks at your local branch tried to withdraw their cash on the same day, the bank would run out of money before lunch. This isn't a conspiracy theory. It's not a glitch. It's how the system is designed to work. Let me show you something. Right now, across all the banks in America, customers have deposited roughly $17 trillion. That's the number you'd get if you added up every checking account, every savings account, every balance showing on every screen. But here's the thing. The actual cash sitting in bank vaults? About 1 trillion. The rest is just numbers, promises, entries in a database. Your $5,000 isn't waiting for you in a drawer with your name on it. It's been loaned out multiple times to multiple people, and somehow it still shows up when you log into your app. Welcome to fractional reserve banking, the magic trick that makes modern finance possible and occasionally causes entire economies to collapse. Let's go back to basics. When you deposit money at a bank, what actually happens? Most people imagine something like a safety deposit box. You hand over your cash, the bank locks it away, maybe they charge you a small fee for storage, and whenever you want it back, they return it. Simple, secure, boring. That's not what happens. When you deposit $100, the bank doesn't store $100. They're required by law to keep a fraction of it. In the US, that fraction used to be 10%, so they'd keep $10 in reserve and immediately lend out the other $90. But here's where it gets strange. That $90 gets deposited into someone else's account. Now that person has $90 showing in their balance. The bank keeps 9 of that and lends out 81. That 81 gets deposited somewhere else. The cycle continues. Your original $100 just became 100 plus 90 plus 81 plus 73. By the time this chain reaction finishes, that single $100 bill has created nearly $1,000 in total money supply. One bill, 10 accounts, all showing real balances. And technically, every person in that chain can withdraw their money whenever they want. Technically. Now, here's the part that should make you uncomfortable. In March 2020, the Federal Reserve dropped the reserve requirement to 0, not 10%, not 5%, 0. That means U.S. banks are no longer required to keep any of your deposits in reserve. They can lend out every single dollar you deposit, and your balance will still say you have money available. The only thing stopping them is their own internal risk management and the assumption that not everyone will ask for their money at the same time. That assumption has a name. It's called confidence. And when confidence breaks, the entire system freezes. Let me tell you about a morning in 1930. It's a Tuesday in the Bronx. A rumor starts spreading that a local bank is in trouble. Maybe they made some bad loans. Maybe the owner gambled away deposits. Doesn't matter. The rumor spreads. By noon, there's a line outside. By evening, it's a mob. Everyone wants their money, now. The bank has plenty of assets, real estate, bonds, loans that will be paid back over time, but they don't have cash, because that's not how banks work. They can pay out the first 50 people, maybe 100. Then the vault is empty. The bank closes its doors. Now the rumor is confirmed. The panic spreads to the next bank, then the next. 4,000 banks failed during the Great Depression, not because they were bankrupt, because everyone wanted their cash at once, and cash didn't exist. This is called a bank run, and it's the nightmare scenario that fractional reserve banking creates by design. You might be thinking, okay, but that was 1930. We have regulations now. We have FDIC insurance. we have central banks that can step in. The system is safe. And mostly, you'd be right. The FDIC insures deposits up to $250,000 per account. If your bank fails, you get your money back. Taxpayers cover the loss. But let's talk about Silicon Valley Bank, March 2023, 16th largest bank in America, over $200 billion in assets. In less than 48 hours, customers tried to withdraw $42 billion. That's not a slow leak, that's a stampede. The bank collapsed. It was the second largest bank failure in U.S. history. Why? Same reason as always. The money wasn't there. It was invested in long-term bonds, safe investments, technically. But when you need cash immediately, safe doesn't matter. Liquid matters. SVB had plenty of wealth on paper. They just didn't have $42 billion in cash, because no bank does. Here's the irony. The system works because we all believe it works. Your bank balance is real because everyone agrees it's real. The moment that agreement breaks, the money evaporates. It's not backed by gold. It's not backed by physical currency. It's backed by collective trust and the assumption that the Federal Reserve will print more money if things go south, which, to be fair, they will. That's what central banks do. They're the lender of last resort. When banks run out of cash, the Fed creates more, digitally, instantly, as much as needed. But here's the trade-off. Every time they do that, every dollar in existence becomes slightly less valuable. That's inflation, and you're holding the bag. So what does this mean for you? It means your bank balance is a claim on money, not money itself. It means the financial system runs on leverage, velocity, and a very thin margin of error. It means the number on your screen represents a promise that can only be kept if most people don't ask to collect at the same time. It also means the economy can grow faster than it would under a system where every dollar had to physically exist. Credit expands, businesses get loans, people buy houses, the machine hums along, until it doesn't. Most of the time, this works fine. You deposit money, you withdraw money, the bank makes a profit, everyone's happy. But the system has a built-in fragility. It requires confidence, it requires coordination, and it makes you never ever think too hard about where your money actually is. Because once you do, the answer gets uncomfortable. Your $5,000 isn't sitting in a vault. It's not marked with your name. It's been sliced, multiplied, loaned out, and turned into someone else's mortgage, someone else's car payment, someone else's number on a screen. And all of it works perfectly fine as long as everyone keeps believing. So here's the question: what happens when they stop?